All right, my name is Chris Campbell. I'm a practicing CPA and I work with small businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So today we're going to talk about this one big beautiful bill. So a lot of things in the not going back and forth about it, but it's here. It eventually passed. It was signed into law on July 4th. So I wanted to walk you through some of the points that will affect a good number of business owners as well as a good number of individuals. It's not going to touch on every point, but I've reviewed the bill and I'm going to walk through some of the points that will apply to a lot of folks and how it may impact you. And again, this is for both business owners and individuals. So I'm going to start out with the business owner side. Now, I will say that from looking at the bill, a lot of the bill was actually keeping intact a lot of the provisions that came on board for that first tax change. I always refer to it as the Trump tax. So when Trump was in office the first time around, there was a sweeping tax bill and there were a good number of changes. However, when those changes were made, they weren't permanent. A lot of these changes set back in 19 or 18, whenever it was set, that some of these provisions were supposed to sunset or end by the end of this year. That's why that was one of the first things that Trump wanted to do when he got into office, was to have a sweeping bill so that a lot of those things could keep going. So from a business standpoint, there weren't too many big changes. I would just say that a lot of it was to preserve what was already set. So the points that I do want to make are some things that have actually changed that I think will a big impact. So first thing, the bonus depreciation, which is technically called Section 168. And this was big because this actually allowed folks in businesses to take 100% deductions on fixed assets. So equipment, vehicles, machinery, those type of things, where you were allowed to deduct a good portion of it over time. So the way it was set up before is that you could take 100% that you can write off right away. Then it dropped to 80 the following year, then 60, then 40, then 20, then it was supposed to go to zero. So right before the bill, we were down to 40% that you can write off right away. And now with the change, it jumps up to 100%, and it's supposed to stay that way. So you don't have to worry about it dropping down to 80 and then 60. So basically it allows you to write off pretty much all your equipment, vehicles. Has to be 100% for business, but it does allow you to take the 100% right away versus the reduced amounts that were available before. Now, there is something that's already available outside of that, which is called a Section 179, where you can essentially write off all of your equipment right away. The difference here, though, is that with this new law, the 168, these deductions allow you to have a net loss. With the 179, that you can already do the same thing, write off 100%. You can bring your business income down to zero, but it doesn't allow you to go negative. What the cool thing about this bonus depreciation or 168 law is that it allows you to not only go to zero, you can have a negative net income. This rule was a popular play with the whole short-term rental movement. Some folks that might have had short-term rentals, you go and you make a lot of investments into the property and start improving it, and then you can write it all down right away and then take that loss. So this is the law that allows you to do that, and that's why it wound up being a huge win for folk in that space. So we will happily be able to take advantage of that. The next thing, which I thought was a pretty big impact, was research and development costs. So prior to the change, if you had research and development costs, this is more geared towards folks that might have been in manufacturing, but I've seen it more some with folks that say are working on developing like software or a product where you're paying a lot of coders and developers and you're trying to create a product, say a functioning app. So a lot of those costs were deemed research and development costs. Now, prior to the change, you could not expense those all right away. You would have to expense those over the course of 5 years. So let's say that you're paying your developers and they're working on launching your app or your web app. Nowadays it's AI, right? So you have a lot of folk developing things with AI. A lot of that would be considered research and development. So in the past, you would only be able to deduct those costs over 5 years. And that's if the expenses were domestic. So let's say if you hire developers that were overseas, which I know a lot of folks do because they don't cost as much. It's a lower expense to take advantage of the arbitrage between paying folks overseas with US dollars. That was even worse where you could only over 15 years. The law is now going back to where you can deduct it immediately. However, it only applies to domestic costs. It's in a nod to encourage these companies to pay folks over here. They now allow you to take those deductions right away versus waiting for 5 years. And it allows you to go back and revise expenses that you might have paid and started the deductions over time in the past. So for example, starting from 2022 forward, you can actually revise. So if you had R&D expenses that you started to deduct over the course of 5 years, you can go back and revise the returns and actually take 100% in that year. So, and that's something you can do right now. So that was a big win for folks, and I think it will encourage folks to do more R&D on the state side. So big changes there. And another change, which was geared more towards angel investors, those in the tech community or startup community, is the increased exclusion of QSBS. QSBS stands for Qualified Small Business Stock. I know a good number of folks that might be either tech founders or in that tech space or angel investors. One big, I guess I wouldn't say a loophole, but a law, but I guess it encourages folks to invest in startups. But one big way that they save a lot on taxes is with this QSBS exclusion. And long story short, it allows you to exclude up to $10 million in cap gains. So put it in somewhat easy perspective. Let's say that you were an early investor in Facebook. You put in when it was very, very small. Let's say Zuckerberg was still in the dorm room and you put $10,000 in and you're holding on to it to what it is today. It's probably be worth tens of millions of dollars at this point, if not more. You can exclude in that instance up to $10 million in capital gain if you were to turn around and sell those shares. So that's what it was set up for originally. That exclusion has now gone up to $15 million. So you get an extra $5 more million to exclude on the cap gain. And there are some rules as far as how to qualify for it. The long story short is you have to hold the stock or securities for about 5 years. That's what it was before you would qualify for it. But now they've relaxed the ownership requirement and it's now down from 5 to 3. Now you may not necessarily qualify for the full 15 million exclusion after holding the security for 3 years, but you do get some credit for it. I don't want to get too deep into it, but the idea is that it's encouraging more to invest in tech space. So if you have a potential high growth company, definitely want to take advantage of this. And so that's pretty much most of the notable things from the business side that I think would affect many of my clients and most folks. Again, there are a few more things in there, but I think that are very granular, very specific. So I will let those be for now. So taking a look on the personal side, there were quite a few changes on the personal side, and I'll go through them here. So starting with the standard deduction has gone up a bit. I would say more so than normal. So they bumped up the standard deductions a little bit. So if you don't itemize, if you don't come up with a number of other deductions, everybody's first dollar amounts up to the standard deductions. So for example, single filers, if you're single or married filing separately, your standard deduction is now $15,750. So your first $15,750 is free. Married filing joint, it goes up to $31,500. I think before it was at $30,000. Head of household, it's now going up to $23,625. So you got a little bump there, but that goes up every year. But they bumped it up a little more than what it normally was. So everyone's going to save a little bit of money. But one thing that I think is really big is there's an extra deduction for seniors, for folks over 65. On top of these increased standard deductions, there is an extra $6,000 per person extra deduction that you get. So if you're filing jointly and you're both over 65, you can get another $12,000 off your taxable income. I think that's going to be a huge saving. When Trump was campaigning and trying to push this through, one of the things he was campaigning on, no tax on Social Security. That part wasn't done, but I think this was the answer. They did this instead. So Social Security is not totally free, but again, they're giving you an extra $6,000 per person, $12,000 if you're joint off of your taxable income. So for many people, Social Security is not even taxable anyway. If you make over a certain amount, it is. Either way, they're giving you the $12,000 back. Now, there are income limitations to it. So if you make under 175K jointly, you get the full 12,000, and it's to phase out up to 250,000. So if you make over 250,000, you won't qualify for it. But you make under that, in some way or another, you will be able to get some, if not all, of the 12K. So that's good. Next thing, there is a deduction for interest on new car loans up to $10,000. Now, the car does have to be new, and it's starting in 2025. So you've had to have purchased the car in 2025, and it must be for personal use, not for business use. And the caveat here is that the car must have final assembly in America. Now, understand that it says final assembly, so it doesn't necessarily mean that it has to be an American brand. It just has to have final assembly here. And as per the IRS definition, there are a number of foreign brands that have final assembly in America. So, and when you hear American made, you don't have to restrict it to just American brands, because there are a number of foreign brands that do assembly here. I was actually looking it up briefly. I saw some lines of BMW, Mercedes. So yeah, you have some high-end cars here, as well as your run-of-the-mill. I think Hyundai's another one. You'll just have to look and see if your brand of the car falls under it. But also look for certain models, because with the foreign brands, not every model would qualify for final assembly here. So if it is something you're looking to take advantage of, and it has to be a new car, and look up and see if that particular model would qualify. You can deduct up to $10,000 each year, but there are income limitations. If you are single, it goes up to 150K. If you're over 150K, you don't qualify. If you're single, if you're filing joint, the income limit's to 250K. So you make over that, you can't take it. You make below that, you'll be able to take some, if not all. Ooh, next one, no tax on overtime. So this is a deduction of up to $12,500 per person, or $25K if filing joint. So if you're filing single, $12,500, or married filing separately, $12,500. If you're filing joint, $25,000 on overtime portion. So again, there are income restrictions. So if you're filing on your own, you qualify if you make 275K or lower, and if you are filing joint, that goes up to 550K or lower. So it's pretty generous as far as the income levels on that. Now, it will create a new burden for employers, because now they'll have to report to the IRS where you have to indicate, when you pay a person, how much was allocated to overtime. With most folks, with your payroll systems, you already record that, but there's probably just be an extra requirement to let the IRS know how much you paid this particular person in overtime. So pretty generous deduction there. So many people be able to take advantage of that. So another hot topic you would hear thrown around, no tax on tips. Now, there's a big caveat here, because the way it turned out is you actually get a deduction for the tips that you received. This only applies to cash tips. For many, maybe in the service industry, I know sometimes cash tips don't make it to the W-2, but if they do, you get a deduction for such tips. So it is up to $25,000 that you can deduct. And also the other limitation, you have to be in an occupation in which tips are customary. So that will be determined by the IRS. There's no way around it. And I'm sure they have this set up so that not every employer turns around and says, yeah, I paid my office worker a tip of up to $25,000 in cash, so that they can turn around and deduct it. So unfortunately, it won't be that easy. The IRS will put out a list that will list all the occupations where a tip is considered customary. So be on the lookout for that. This will be another reporting requirement for the employers to submit that to the IRS, but it could be a big boon to those that qualify for it. Next thing, this is big for especially those that live in high income tax, high property tax areas. So myself, I'm in the Northeast, I'm in New Jersey, some of the highest property taxes in the country. A lot of my clients in this area will definitely benefit, as well as those that pay a lot of income taxes. So those in New York City pay a city tax as well. So this deduction here is called the SALT deduction. Prior to this change, you could only deduct up to $10,000 in taxes on your personal tax return if you itemized. Now, most folks who owned a house, and if you carried a mortgage of about 400K or so or more, you usually qualified to itemize. And a lot of that was because you can only take up to $10,000 in taxes. So mind you, when we say $10,000 in taxes, that's a combination of your property taxes and your estate taxes. So with most folks in high property taxed areas, you're paying more than $10,000 just in property taxes. So the income taxes that you paid, where in the past you would have been able to deduct, with the tax law change that came in 2017, you were only able to take $10,000. Now that has changed, and that $10,000 has now gone up to $40,000. There are income limitations, so if you're making $500,000 or less, filing jointly, or if you're filing but on your own, $250,000. So this is very impactful because I can't tell you the number of clients that I've dealt with that have homes. And when they purchase the homes, one of the big selling points of the home is that, oh, it's very tax efficient. You get to make all these deductions and get these write-offs and the mortgage that you're paying and all the taxes and all. You get to deduct that on your taxes. That was a big benefit. However, if your house wasn't much or you didn't carry that much of a mortgage, and again, that threshold usually I saw was maybe like $400,000. It didn't do anything for you. So you were paying all these taxes, both in income tax and property tax, and you got zero benefit out of it. So now with this change going up to 40,000, you're now going to be able to take advantage of that. So those that were paying a good amount in property taxes and state taxes, you should be able to get a nice benefit from that. So this was a big, and I'd probably say from the personal side, this was probably the biggest change, at least that I see amongst, my clients. All right. The other thing, charitable donations, a few things have changed with that. So a good thing is that even if you don't itemize, and if you don't own a home, you're probably not going to itemize. So, but if you don't itemize now, you can still get a deduction for charity donations of up to $1,000 if you file single, or $2,000 if you are married. In the past, if you didn't itemize, there was really no benefit of any charitable deductions. I would tell some clients, donate because you want to and out of the goodness of your heart. But if they didn't itemize, it didn't really do much for them. It wasn't a strategy that was really used because they couldn't itemize. So there was really no impact by making donations. So if you didn't itemize, you had to donate so much in order to get a deduction for it. It was pretty tough for some fast, but now with this, you can now get a deduction without having to itemize. And this is starting in 2026, so not 2025, 2026. But on the flip side, there's now a limit of how much can be deducted if you do itemize. So before, it was as long as you itemized, you get a deduction from $1. You donate $1, you get a deduction for $1. Now that's changed where the deductions have to exceed 0.5% of your modified adjusted gross income. Just to put it in perspective, let's say that you make $250K, right, and you itemize. You would now have to donate more than $1,250 for it to count. So gone are the days I donate a couple $100 here and there and I'll put it through. You're going to lose out on that. So that's the flip side of it. If you don't itemize, they make it easy for you to deduct. If you do itemize, now you got a threshold before they let you take advantage of it. So those are the big changes you'll have to account for. Hopefully this was helpful. If there's any more questions that you may have, or if you're not sure how it may apply to you, feel free to reach out. Happy to help. All right. So that's all for now. And I'll look forward to talking to you on the next one. Take care.